Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. Today on the show, we're going to talk about Treasury bills and Treasury bonds. I know, don't get too excited, but hear me out on something, friends. Bonds run the market. Now, I know how that may sound. I'm going to repeat that, though. Bonds run the market. And I'm going to talk about that today. And we're going to talk about specifically Treasury bills and Treasury bonds because a couple of weeks ago, I had mentioned on our show around 5 places where you can put cash other than your bank to earn high yield and high interest. We've got a lot of comments, a lot of questions on Treasury bills and the differences between Treasury bills and Treasury bonds. So we're going to go into that today. But before we do, make sure to go to our website at onecapital.com. You can click on our media tab. There you can actually download and subscribe to the Make Your Money Matter show. You can also download the podcast on any other platform, whether that's Spotify, SoundCloud, the Apple iTunes app on your phone, or Google Podcasts. And do me a favor, leave us a comment, give us a review. It's good to share. I want to hear from you all. This show is actually written on some comments we got. So the more I hear from you guys, the better. And I really appreciate each of you listening. And with that, let's get into it. Now, again, a few weeks ago on our show, I mentioned the 5 areas to place money other than just your bank account. So I want to talk about Treasury bills because that was one that struck a chord with many of you out there. And I want to be very clear. A Treasury bill, or otherwise known as a T-bill, is backed by the full faith of the Department of Treasury here in the United States, which is why it's considered one of the safest investments. Now, many of you rolling your eyes right now, please, I understand there's some commentary likely around the U.S. debt and dollar and consistency, but we just got to look at history here for a second and go with the fact that this is still considered widely among all the investment acumen around the safe investment. And here's what I want to bring up today. And I've seen this in my practice here with many of my clients, maybe listening as well, that savings, and by the way, this is across the U.S., savings rates across the U.S. have actually gone up this year in 2023. So for many of the clients I've been speaking to, which is why I wrote the episode a couple weeks ago around other areas to place cash to earn investments, to earn actually high yield investments. And I talked about money market mutual funds. I talked about Treasury bills, high yield savings accounts. So I just want everyone to know that, you can get more money, 3, 4, 5% actually right now with keeping it still liquid. But it's a really good place to park your short-term cash, which is why I'm bringing up T-bills. Because if you have been looking for a place to store savings, earn interest in the short term, all right, Treasury bills is a good option. Now, T-bills have maturity dates of less than a year. And I'm going to talk about the difference between a T-bill and a T-bond here in a second, but let's just stay on T-bills, Treasury bills. They have maturity dates of less than a year. And here's the thing, guys. While generally longer-term treasuries pay higher yields, short-term Treasury yields are actually currently higher, which is actually why I'm bringing this back up this week and why I mentioned it a few weeks ago. Friends, here, let me give you an example. Right now, the 3-month Treasury bill is right around 5%, just a little bit under, while the 30-year Treasury rate, or the T-bond, is right at 3.84%. Now, mind you, I understand these are different durations and technically different debt obligations issued by the government, but it's a good marker, and it's actually how most mortgage rates are run. So it's a good indicator of what's going on. So again, short-term rates near 5, longer-term rates under 4. So if you're looking for a risk-free way to earn interest on your cash over a short period of time, a T-bill is actually a good choice, okay? So remember, although T-bills don't typically earn as much as other securities, like maybe a stock, a dividend-paying stock, right? They still offer higher returns currently than traditional savings accounts or other, cash accounts right now. And I share that reason because one of the things as an advisor we always have to do is to be on the forefront to educate and inform, which I do with my clients here at One Capital Management. I like to do each week on the show for those of you that aren't clients of ours here, just to know that if you're talking with your advisor or if you're doing it yourself or whatever it might be, right? Know this. Over the past 15 years, let's just call a spade here, all right? We've been a little bit spoiled, okay? We've had artificially low, basically zero interest rate market. And in hindsight, looking back, we've had a very good bull market run on the S&P 500 and the Dow. We've been a little spoiled. The past 18 months has been, we'll call it somewhat of a reckoning for many. And I think a lot of us, if we're honest with ourselves, we get stuck in our own ways, right? We just think, we're still getting paid less than 1% in the bank account. We just still think that rhetoric is going on, that narrative in our mind is still happening. And what I want to share here is that's not the case. You can go get liquid dollars through money market mutual funds or things like T-bills or T-bonds that are earning 4 and 5% right now. Mind you, that's basically equal to what inflation is right now. And I think over the long haul, we'll see it go down here with the M1, M2 money supply going down. We're seeing a stall in interest rates. We might see another increase here and there. But the point is we want to at least get back what we might be losing as prices around us are going up. And again, going to say this again here, that it's still the risk-free rate. Now, what do I mean by that? In the investment world, us investment managers, we have to look at something called the risk-free rate. We always compare and look at what our clients could get risk-free. Now, mind you, there is no such thing as pure guarantees and risk-free. So I want to be clear about that. But it's widely accepted that Treasury bills, Treasury bonds, government-issued securities, or I should say debt obligations here in this regard, are considered the risk-free rate. Let me give you an example of how this plays into action, okay? If I'm an investment manager and I'm working with a client, and we're talking about short-term cash, or maybe even long-term dollars for that matter, in their portfolio. One of the things I would have a discussion with in my portfolio team is, okay, where is the risk-free rate right now? Now, for many years in my career of nearly 20 years in this business, the risk-free rate was right around 2 or 3%. What that means is this. I know my client can go and earn 2 or 3%, which is basically equal to inflation over the last 30 years as well, at basically no risk, okay? So let's start there. That's like first base, all right? Then we have the conversation about, okay, what do we want to do with the money? What's the goal with the money? Okay, we want to grow more than that. It gives us a starting point, let's just say, for us to have a conversation around how much risk someone wants to take on. For many of you listening right now, this is a great tool to understand. Now, as you can see, right? And by the way, when I say more risk, we're talking about more equity. Obviously there's risk in it, there's volatility in it, but over the long haul, you've also see dividends and appreciation in the market. Now, let me bring this to current day. When the risk-free rate goes up, which currently, let's say it's right around 5%, all of a sudden our risk-free rate becomes a little bit more to think about. We're like, hey, wait a minute. We don't necessarily have to go take on a whole bunch more risk. If I can go and get a risk-free rate at 5%, right? It resets the clock a little bit. Our spread, if you will, from a 3% to let's say an average 8%, that's a hypothetical, right? In that scenario is 5% spread to take on the risk. So we have a conversation and say, okay, are you willing to take on the risk for an extra 5%? Yes? Okay, great. Let's go and allocate and manage. If the risk-free rate is 5 and we still have hypothetical 8% average returns, all of a sudden our spread to take on the risk becomes 3. It's smaller. So we're earning less by taking on more risk. You see what I'm saying here? This is where we have to work with clients. This is where an advisor really comes in as value to you to help you assess that for your goals.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, specifically speaking about Treasury bills, I want to talk about, I got a couple questions on this, is how to buy them. There's a couple ways, but I want to talk about mainly 2. One is direct through the Treasury Department, which the website is treasurydirect.gov, okay? Or you can do it through an advisor. Now, a couple things. To start an account with Treasury Direct, you'll obviously have to provide an address, social security number, and a bank account, okay? And then once the T-bills are sold, now you got to remember, T-bills are sold on auction. They're debt securities, and they're issued at a discount. Meaning if you bought a 52-week T-bill or a 1-year T-bill, you're going to technically buy it at a discount, and then after the year is up, you'll get your full 5% plus the original premium or the original purchase payment back. So it's considered what's called imputed interest, meaning you're not getting a check every month or every quarter or every 6 months as you would maybe in a T-bond, which I'm going to talk about next. Now, there's 2 downsides by going direct, and this is just my opinion, so just hear me out. One is you don't have an advisor to actually manage it with you, and I'm going to talk about that here in a second. But the bigger one is this. If you're looking to buy a T-bill for maybe your IRA or your 401k, deferred compensation plan, anything tax deferred, you actually do have to go through a broker or an advisor because you cannot do that directly on treasurydirect.gov, which that leads me into my second way you can obviously purchase a T-bill for your investment portfolio, which is through an advisor. And I want to share this. I think there's a misnomer out there that thinks if you go into something like that, cash or something like that, that there's like no management to it. And I would argue that there actually is a lot of management to it. In fact, I was having an internal conversation with my team just the other day about this because we've done a lot of these for clients over the past 6-9 months because of the rates, right? We're doing cash management. So hear me out. Portfolio management largely encompasses cash management, or said differently, cash management is a large part of portfolio management. And let me give you an example here as it relates to a T-bill. Treasury bills have 6 maturities: 4 weeks, 8 weeks, 13 weeks, 17 weeks, 26 weeks, or 52 weeks. Obviously, the flexibility here is a key advantage, and it allows investors to better manage their short-term cash, which is why I'm bringing it up. But you also notice that the longest one out there is 52 weeks. So let me give you an example of what I mean by cash management and why an advisor would make sense to help you with some of these things, right? Is let's say you went out and bought a 4-week T-bill. Obviously, it's going to yield a little bit less than the 52 weeks. We won't get into the semantics of that just right here, but hear me out. We know and we've seen that interest rates and decreases right now are a pretty fluid conversation. So we want to make sure that if we buy a 4-week that we're ready to repurchase something at hopefully a higher rate after the 4 weeks is up. Said differently, we don't want to go out too long and have a 5% when the Fed might raise rates in 2 months, okay? And all of a sudden we now have a lower premium paying T-bill than the current prevailing rates. So active management actually becomes a large part of this. So you can see how it's a really key indicator in terms of how you want to buy it. And specifically, obviously, if you need to buy it within a tax deferred account. And that is a good segue into the second part here I want to talk about, because one of the questions I got, actually a couple of questions I got from the podcast and from some clients on this show a few weeks ago, which you can reference around the 5 areas to store cash or put cash other than your bank account, was the difference between a Treasury bill and a Treasury bond. There are 2 critical differences investors need to understand. So I'm going to talk about the differences here, but before I talk about the differences, let me just share the similarities for a second, because they are similar in a lot of ways, which is why I think a lot of people, a lot of investors get these 2 mixed up for a second, all right? So again, Treasury bills, 6 maturities, no more than 52 weeks, all right? Treasury bonds, on the other hand, only have 2 maturities. They're for 20 years and 30 years. Now, obviously, to bypass lengthy maturities in T-bonds, you can sell bonds before they mature. By the way, the same goes for Treasury bills, as I mentioned. This is a common practice. As each investor, really, if you think about it, each of you out there have unique goals and requirements for their portfolios, which is, by the way, another reason to have an advisor work with you on this, because as yields change, you can actually adapt and sell some bonds potentially. But here's the thing. When you sell a Treasury bond, it results either in a capital gain or a loss, right? Obviously, thanks to the inverse relationship between the price of a bond and interest rate levels. When interest rates rise, a Treasury bond prices will generally fall, and vice versa. Now, to round that out for a second, let me give you an example of what I mean there. Suppose you bought a 20-year Treasury bond for $1,000, and it has a fixed rate of 4%. Now, after a year you own this bond, the interest rate rises to 6%. As you can see, it will likely be tough for you to sell your bond when the interest rate currently is higher. Why? Because a buyer could purchase the same type of security for $1,000 and get the higher rate at 6%. So you would have to, and if you wanted to sell your bond, or you need to liquidate, or you found that house you wanted to purchase, or you needed the cash, or whatever scenario you want to run, this is why an advisor is so important here, you'd have to lower the price of your security below the $1,000 that you purchased for it in order to make it so that the yield on someone buying it is equal to the 6%. And if you do that, it means you lose out on some of your principal investment. So essentially, the thesis is this: when rates are low, it's a great time to sell, because looking at that same 4% bond you purchased, if the interest rates fall to say 3%, the value of your bond will have increased, right? So you'll have a capital gain in that scenario. It might be a capital loss in the other scenario. So just real quickly, the first main difference on a T-bill and a T-bond is obviously the maturities, okay? Again, T-bills have 6 maturities. Quite frankly, there's only 5 of them that are really used, the more common ones, but there's 6 maturities, no more than a year, and a T-bond only has 2, 20-year and a 30-year. The second big difference, I alluded to it a couple minutes ago, is how the interest is paid. In a Treasury bill, again, it has what's called imputed interest, which means the interest is calculated as the difference between the price you pay for the security and the amount you get when it matures. I mentioned this a few minutes ago. The federal government in this scenario in a T-bill will not send you like a check or deposit interest payments because T-bills are sold, again, as I mentioned, at below face value or a discount. But again, when they mature, you're paid the current face value of that bill. Have I lost you already? I know this wasn't the sexiest environment to talk about, but I promise you it is very important. Now, the flip side of that on interest paid for a T-bond or a Treasury bond, the government will pay you a fixed amount of interest every 6 months until maturity. So suppose, an example, you purchase a bond for $1,000, like I said before, a T-bond, and the interest rate is 4%. In this case, you will get $20 every 6 months. Make sense? So again, it's how the interest is paid is one of the differences. So I want to talk about a T-bill because I do think it's a really good investment for many out there thinking about it. You can reach out to us. We will help you with this. Make sure you talk with an advisor about this. You can purchase it direct, obviously, but there's some nuances you should know about. And obviously, as you invest in debt securities, which is what these are debt obligations issued by the government. I think considering the critical differences between a Treasury bill and a Treasury bond, and also there's a third one called Treasury notes, but it's important to know the difference in order to make, I think, the best choice for your short-term and long-term goals. Hey, I want to thank you for listening to the Make Your Money Matter show. As always, remember, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can visit us at onecapital.com or give us a call at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.